I'm David Smith and this is Valley Mole, the show that digs in and around Silicon Valley, searching for insights into technology news stories, the patent wars, and the business of startups. Looking back on 2011, Dow Jones Venture Source reports there were fewer exits by United States venture-backed startup companies. There were fewer mergers and acquisitions and IPO exits. There were 522 exits of all types, including mergers, acquisitions, buyouts and IPOs. And these netted $53.2 billion, which is a drop of 14% over the 2010 figures. Now, what's interesting here for me is the median price, the average price that was paid to acquire a high-tech startup company in 2011. And the median price was $71 million. And the median investment in those companies by venture investors was $17 million. So the business model looks pretty good. $17 million invested, $71 million paid for the company on exit. Now, if you consider that it took an average of 5.3 years for those companies to go from the initial startup investment stage to exit, it's not a great return. And if you also consider that the venture investors don't own all those companies, they have liquidation preferences that give them their money back, plus often 50% once the company's sold, and then participate in the shares. But if you consider, let's say they own about half the shares of the company, each company, you know, an investor may be investing $17 million, waiting 5.3 years to sell that company, and they get back about $35–40 million. So it's 2x return, and it's not a great deal. IPOs, though, could be the savior. This is where the venture investors have hit it out the ballpark in previous years. And IPOs in 2011 showed an increase. There was an increase in value, but not an increase in the actual number of IPOs. The value of IPOs in 2011 was $5.4 billion was raised from public investors, which is an increase over 2010 when $3.3 billion was raised. But almost all that increase is due to the large IPOs by Groupon and Zynga, which came in toward the end of the year. And in those investments, the venture investors had invested $85 million over a period of 6.5 years. Now, the venture business model, if you look at mergers and acquisitions as an exit, a 2x return on your investment over 5 years, as I mentioned, is really insufficient to fund the business when you consider that probably 90% of the companies that the venture investors invest in do not reach a successful exit. The success rate is very low. The top tier investors get a success rate of maybe 15% in terms of profitable exits. So if you're funding a large number of companies that don't actually make it to merger acquisition or IPO, and then you only get a 2x return on the ones that hit mergers and acquisitions, you've got to hit it out the ballpark on IPOs if you're a venture investor and you want to make a profit. But the Zynga shares today hit a low of $8. Groupon went down to $18. Each of those prices is substantially lower than the initial IPO price a couple of months ago. So the Wall Street investors have lost their money on these IPOs so far. And the IPO window, as a result, may be closing for venture investors, not opening. There may not be a great appetite in 2012 for startup IPOs. 2012 may not be a fun year for venture investors. The established VC model cannot be profitable in the current environment. VCs need to make smaller investments, they need to get higher success rates and higher exit values if they're going to turn a profit in 2012 and beyond. We'd like to thank the sponsors of Valley Mole: Tynex, the full-service patent broker operating the world's largest patent and technology trading exchange; SVBS Silicon Valley Business School, providing unique educational materials and resources to students and teachers of entrepreneurship and technology commercialization; and ValueMyPatent.com, the only place to go for rapid, realistic patent appraisals.